push comes to shove, we'll take a closer look at the next industry to face disruption. Plus, we have an award-winning journalist and author to share the lessons from the C-suite. This is 7-Day Yield.
Welcome to 7-Day Yield. I'm Mitch Rochelle.
And I'm Lydia Morish, and here's what's trending. Nearly a decade after the start of the global financial crisis, financial institutions still face low growth, low margins, and a highly regulated environment. According to the recent PwC Global CEO Survey, roughly 55% of financial services firms plan to cut costs in the upcoming year. Strategic investment is cited as a priority of many firms in the coming year.
Is fintech a threat or an opportunity? A recent PwC study examined the contradiction of views that the market participants have regarding fintech. Interestingly, 2/3 of those surveyed saw mainly margin pressure from new market participants, while 3/4 of those surveyed believed that fintech generated new pathways for cost efficiency. It seems that one person's threat is another person's opportunity.
Well, sticking with the theme of disruption, blockchain technology is still making the headlines. But where and how might this play out? A recent report by the PwC Financial Services Institute noted disruption might take the form of cost savings. In fact, the reinsurance industry could save as much as $5 to $10 billion from improvements in claim settlement and compliance. Well, on the topic of disruption, I recently chatted with Barry Benjamin, PwC's Global Asset and Wealth Management leader, and asked him how the industry is dealing with all those changes in technology. Take a listen. So Barry, disruption seemed to be the key buzzword in 2016. So looking ahead into 2017, do we expect to see more disruption, or are we going to be looking at something else?
It's just getting started. Disruption is a long-term impact for the industry. The DOL rules are certainly affecting how firms are going to be dealing with the clients and their customers, and what kinds of information they have to provide, how they do business, what's best fit. So that world is really changing. And really what it's driving at is that the cost to do business is going to continue to increase. The impact that has on fee pressures with transparency from DOL, as well as the need for scale at our client base, is going to drive a lot more disruption. Their need for scale is leading to increased M&A activity in the marketplace. We've seen a few deals here at the end of 16. 17 is going to see more. Disruption is really about new parts of the business really changing, either new entrants, or the rules really changing as far as how our clients need to do business, and that's really what we're going to see more of in the coming year.
Mm-hmm. We've talked a lot about DOL on our show, and obviously that's going to impact the future of advice. So how can companies really look at, if they're building out platforms, whether they serve the mass affluent, high net worth, even ultra high net worth, how does that impact how they can build these models to scale and their platforms to scale, so that they're not having to build out multiple models for different segments of the market?
Absolutely. And most companies do not have well-developed digital strategies yet. So there's good and bad news in that. The bad news is that, well, what's taken so long? And the clients are demanding more around the digital. The good news is that they haven't made investments necessarily in technologies that aren't fit for purpose. So the real answer to me is, if you look across business segments, really more about thinking about a platform that fits all purposes and leveraging the kinds of technology tools, so-called APIs, where you're able to plug and play into your platform. APIs really allow you to best-in-class types of technology tools that fit, whether it be an ultra-high net worth individual with very different demands than the mass affluent market and what they're able to pay.
Right.
So I think that's really the way people are starting to come at it, is one uniform platform with different APIs that are fit for purpose.
Mm-hmm. And you touched a little bit in your first response about M&A. So are we likely to see some M&A specifically in the digital space, and look at some of the wealth management firms either buying out some of these digital platforms rather than building out their own?
Yeah, I think we've seen that so far in the past couple of years, and I think we'll see more of it. What I think is going to happen is a lot of our financial services clients aren't going to have the skill sets or the capabilities to develop some of these tools. And frankly, why? Why invest in that where it's not necessarily akin to your culture? Why not either acquire firms that have built that capability, or frankly partner with them? Maybe it's not an acquisition. Maybe the right answer is to some type of joint business relationship where the digital platform does what it does and the financial services platform does what it does, and you marry those skill sets up. I think we'll see a lot more of those types of combinations.
Great interview, Lydia, with Barry. We're once again joined by our BFF, Gary Meltzer. So when you travel sort of from the East Coast to the West Coast of the United States, do you notice a difference in sort of the mentality of investors and whether they're more, because the West Coast I think of as being very more tech friendly, are they more thinking about using technology as a way of investing?
I think it's interesting. I think we're seeing kind of a coming together of the East Coast and the West Coast. There's been quite
Chicago?
a bit of... Yeah, right, exactly. Yeah, in Chicago, no, it's not really. But you kind of see a lot of migration of professionals that were previously in financial institutions on the East Coast moving into a number of the startups on the West Coast, right? Whether that's fintech or otherwise in the technology sector. So you're seeing more of that. You're also seeing the West Coast technology firms invest in opening significant, offices or presence here in New York or up in Boston or elsewhere in the East. So you really are seeing kind of a coming together. The state of play and where it's been previously, it's been a lot more focused on kind of that segment of the, the country out in Silicon Valley, but you're really seeing a coming together right now across the country.
Well, Barry mentioned that some companies obviously go down the route of wanting to build out their own technology, others acquire. Are we likely to see more transactions or M&A in this space?
I think you're going to see more partnering. Could be transactions, could be joint ventures, could be ways in which a technology firm continues to come together with a financial institution. So we might see that type of activity. Also, if you look at some of the fintech and the startup and early stage companies, what is the ultimate exit strategy for them, right? It might be more difficult for them to kind of go to the public markets. Are they going to sell their technology to a larger financial institution? Are they just going to provide their platform for fee, right, or in a licensing arrangement? There's a lot of these types of things, but I think if you think about financial institutions and what they're going to need and the investments they need to make in technology, they're thinking in many different ways how they partner that together, and M&A may be only one of those, avenues that they choose.
Great, thank you, Gary. After the break, Mitch will be sitting down with Bloomberg's Betty Liu. We'll be right back.
Welcome back. You can learn a lot from talking to great leaders. Bloomberg anchor and author Betty Liu recently visited the 7-Day Yield set, and I asked her about the lessons she's learned from talking to individuals in the C-suite. Take a listen. With a big inventory of CEOs that you've interviewed, what are some of the themes and takeaways that you hear from them about their view on life?
Being really great executors is extremely important when you're a leader. You not only have to be able to set the strategy, but execute it as well. I also think there's a likability factor, and that doesn't necessarily mean that they're nice people, although everyone is generally a pretty nice person. But likability meaning that they're very persuasive. They get people to do what they want to do and motivate them. When I say likability, it's not just about being nice, but also just surprising people. Kind of like out of the box thinking, I think, creates that likability. And the third thing I was going to say about that is that almost every CEO I've met drinks Diet Coke. I think that is like some sort of magic fuel for every CEO.
When you think about the success, and this is a little bit from your book, which I enjoyed reading, but when we think about the success of these individuals, failure seems to be part of every one of their success.
Yes.
So are there takeaways from their failures that made them better leaders of people and companies?
Absolutely. I mean, and I myself, by the way, have failed quite a bit. I mean, people always look at my career and they're like, oh, you've hit this milestone, that milestone. But I've failed many, many times in my career. And I find that a lot with very successful people. One of them that I interviewed, Elon Musk, in that book, I talked to him about failing and mistakes. And I said to Elon, I was like, you don't really seem like someone who is afraid of making, who's afraid at all. You have no fear. And he was like, absolutely not. He said, I have a huge amount of fear. I'm probably one of the most fearful people out there. But he said, my fear is that I have a real fear of regret. So I always want to be doing things, and I push myself. And even when I'm scared to do it, I push myself because I'm more afraid of not doing it than I'm afraid of actually doing it. And he said, I felt deep fear, when my company was almost bankrupt, Tesla, I was sleeping on people's couches. He said, I was extremely afraid, but I knew that if I didn't do this in 5 years, I would absolutely regret not building Tesla, and then look at where he is now.
So on the topic of regrets, is that also a common theme you've seen across other CEOs, that they voice regrets, or do they live to not have any regrets?
They live to not have any. We all have some degree of regret for whatever we've done, but I think that what drives them is that they don't want to have any, they try to minimize that as much as possible. So you can see that across the board, not just in the trajectory of their careers, but also in how they make decisions too. Every CEO says, look, I've not made every right decision. Many of my decisions have been wrong, but I don't regret that I went ahead and made decisions quickly or made them, decisively, because that's what we needed to do. So they try very much to not live in that sort of, wallow of, should I have done that? That backwards looking perspective.
And I don't know if it's apropos to regrets, but throughout a long award-winning career as a journalist, you decided maybe in a life-imitating art moment to become a CEO, and you've created this business, Radiate. Maybe a little on Radiate, what it is and why.
Very perceptive, Mitch. Yes, indeed. I tell people all the time, if you want to do something and you're not sure about it, like look in the mirror and say, 5 years from now, would I regret not having done it? And I did that myself when I was thinking about, do I or do I not want to do this, do Radiate and do it, because it was such a passion of mine. And it's been great. It's been a struggle too. I mean, there's lots of ups and downs. And one of the things that other entrepreneurs have said to me is that one of the great things about building your company is that, yes, you have very low lows. I mean, there are some lows. But they said your highs are unlimited, so your success is unlimited. It's what you make of it. And I love that kind of independence and entrepreneurialism.
So I'll leave you with this. What's your advice as an entrepreneur yourself and somebody who has a startup and someone who's spoken to this vast body of CEOs? What's your advice to someone who wants to start a business right now?
I think one of the biggest things that I've learned, but I always kind of knew it, but it really came to light when I started this company, is you have to get comfortable with the word no. So I think...
My kids are not comfortable with it. Yours probably aren't either.
No, they're not. No, they fight me all the time on it. But I think that the more you try things, the bigger risks you take, the more no's you're going to get. And you have to be absolutely comfortable with hearing that all the time. It can feel gut-wrenching, but you also know that it's because you're taking so much more risk than you were before. So I would just give that piece of advice.
No is the new yes?
Exactly. And no will turn into a yes.
There you go. All right, thanks, Betty.
Thank you, Mitch.
So Gary, you must meet a lot of CEOs in your travels. What seems to be top of mind right now, particularly as the new administration's coming in?
Yeah, I think there's a couple of macro issues that they're all dealing with, right? We're dealing with how will tax changes impact their business, right? So they're certainly thinking about what the tax environment, tax structure looks like going forward, whether that's kind of corporate tax or the issue of repatriation of bringing assets back onshore. There's uncertainty as to where regulation will go and whether or not there will be some repeal or delay in certain regulation that they're dealing with. So certainly that's, top of mind. I think that generally they're pretty bullish that there's going to be investment opportunity because of some of the things that the president-elect and his administration are kind of signaling. So that's been very positive, and I think some of that's shown up in kind of how the markets have reacted. And I think the other thing, overriding all of this is kind of an increased level of political risk and uncertainty. And clearly, as you kind of think about relations between the U.S. and all of our partners around the world, that's something that we're all taking very much of a wait and see, perspective on. But political risk and uncertainty is clearly out there, top of mind to the CEOs as well as their boards.
So Gary, in the asset and wealth management industry, just at the C-suite level, sticking with the question that Lydia asked, is there a lot of performance pressure? Because not only do they have to focus on the performance of their funds and vehicles, but them as an institution themselves, it seemed that with all the competition, there's got to be a lot of performance anxiety and pressure. Right?
Absolutely, and I think they're dealing with the issues that I just articulated, but I think when you're dealing with an investment firm and CEOs of asset managers, they are dealing with, as you said, performance at their fund level, but also kind of how the company itself is performing. And they are very focused on expenses and how they continue to achieve the margins that they would like to achieve for their shareholders and their investors. And they're looking at ways to do that. I mean, clearly we've talked in many episodes on how they're going to look at the relationships they have with outsourcing partners. We just heard, recently a discussion regarding technology and how they're looking at technology platforms. All of those things get them them to address the issue of cost and efficiency so that they can achieve, their kind of expected level of performance. But they've got all the, kind of issues from a macro level that I articulated, and then very much focused on, a performance-based business. At the end of the day, performance is something that still, is out there, that the assets flow in when you have good performance.
Speaking of performance, awesome performance here today, Gary.
Thanks so much,
and your
guys.
tan is
Appreciate it.
better than mine.
I don't know about that.
I don't know.
A little better than it was a couple weeks ago.
I'm all hair and makeup, but that's a legit tan that you have there.
Thank you. Thanks,
Gary.
guys.
On a more serious note, like most enterprises, banks and insurance companies are not immune from being disrupted by non-traditional players. Fintech and insurtech firms have largely been unregulated, just as the alphabet soup of agencies like the OCC and the CFPB are beginning to study these disruptors. The Trump administration is moving forward with a deregulation agenda. Keep watching 7-Day Yield for the latest developments coming out of Washington.
Thanks for joining us today. To catch up on all our previous episodes, you can check out our PwC YouTube page. Plus, you can always follow us at the handle below. We'll see you next time on 7-Day Yield.